财经热点深度解读。大家好，欢迎收看本期的全球财经连线。在8月底结束的杰克逊霍尔全球央行年会上，美联储主席鲍威尔的演讲缺乏新意，因此投资者的目光已经投向9月的议息会议。事实上，目前美联储关注的重点是美国就业市场的表现。最新出炉的8月非农就业报告显示，8月美国非农就业仅新增23.5万人，表现不佳。那么，就业市场的疲软是否会延缓美联储推出 QE 的时间？美国通胀是否会继续攀升？第4季度美国经济前景如何？本期全球财经连线邀请到渣打银行欧美首席经济学家 Sarah Hewin 就上述问题进行讨论。Hello, Sarah. Glad to see you.
Hi, very pleased to meet you.
How do you comment on Powell's Jackson Hole speech?
At the Jackson Hole speech, Powell indicated that the FOMC is ready to start tapering probably this year. This was the message that we had from the minutes of the July meeting, where most participants had indicated that, if the economy evolved as they expected, that the policy tapering could start by later this year. Now, he spent a lot of time talking about inflation. On unemployment, I think, if we take a step back, then even though the message was that policy tapering, would likely be able to start by later this year, there were a lot of provisos. As you know, the Fed has two targets in mind: employment and inflation. And on the unemployment front, while he commented that unemployment had fallen to a post-pandemic low, he still noted that it was still much too high, and that the reported rate of unemployment understates the true labour market slack. So that on the employment front, clearly the view is that there's not enough progress made yet towards the Fed's target of full employment to be comfortable with removing policy accommodation. We had payrolls numbers on Friday, and actually they were disappointing. So the August payroll report showed only 243,000 jobs being created, way below expectations and a much slower pace than we'd seen in June and July. So I think that assessment from the Fed is likely to remain. And obviously it's with that number in mind that they will be going into their meeting in September. Now, on the inflation front, he talked about relatively elevated inflation numbers being temporary. And this is a theme that we've heard quite a lot, that there are transitory reasons why inflation is high, largely relating to supply side disruptions resulting from the pandemic, as well as the high energy prices, high food prices that we're seeing. Oil prices are still pretty high. If we look at the last July inflation number for the PCE deflator, which is the inflation that the Fed targets, then that showed that energy, goods and services inflation was still running very, very high. It'll take time for that to work its way through through other inflation readings. But it's unlikely that we're going to continue to see double-digit inflation in energy prices. In fact, if anything, we would expect energy prices to come down from these relatively elevated levels. So Powell talked a lot about inflation, about why they viewed it as being temporary. Wage increases on Friday the non-farm payrolls report, we did see average hourly earnings rising by 0.6% month on month. But Powell's view, certainly for Jackson Hole, was that there was little evidence of wage increases that might threaten excessive inflation. And he spoke about some measures, for example, the Atlanta Wage Growth Tracker and Employment Cost Index, which suggests that wage growth is consistent with their longer term inflation objectives. So in summary, yes, he flagged that policy accommodation could start to be removed by later this year, as long as the economy evolves as expected. But unemployment is still too high. And while inflation is well above their target, most of the reasons for that are to do with the pandemic. And so it's likely to move closer to target over time.
As you mentioned, the August job report shocked the market. So do you think what's the problem for the current US labor market?
I mean, there are clearly some real disruptions in the economy, and that's being reflected in the labor market. So we had a couple of months in June and July of very strong job creation, which frankly is what we would expect as the economy emerges from the pandemic. And it's also what we would expect as we know that the companies are reporting severe labor shortages. Now, the August payrolls number was a lot weaker than expected. And I think that does largely reflect the surge in COVID cases that we saw through July and August. Largely driven by the Delta variant, the greater transmissibility, and higher numbers of hospitalizations, particularly in states where vaccination rates are still relatively low. So if we look at the where jobs were created, or where jobs weren't created rather, then there was a fall in retail jobs, there was a fall in education, so very much the person-to-person facing sorts of jobs that which would be affected by the pandemic. There had been a real pickup in leisure and hospitality employment in June and July, and actually that really faded in August. So hardly any jobs created in that sector. Again, not surprisingly, given the pace of the pandemic. So you can clearly see that the pandemic is having an impact on jobs, but at the same time, the demand for labour remains relatively high, and that's a constant refrain from employers that they are looking for workers, but they can't find them. So what we expect is that as the COVID situation improves, and particularly this month as maybe kids go back to school, that there will be less concern about childcare arrangements. There will be more comfort with working people going out to work, less concern about COVID. And also, finally, we have the reduction in unemployment benefits. So emergency unemployment benefits come to an end today. And at the margins, that may also increase the supply of labour.
Mm-hmm. Will this week report cloud policy for the Fed?
I mean, I think it will certainly influence their thinking, and it looks unlikely that they are going to announce a tapering in their September meeting. So it's just possible, if we'd had a very strong jobs report, that's on the 22nd of September, the Fed may have signaled that tapering would start in the fourth quarter. But with this weak jobs report on top of other weak survey reports on output and very weak sentiment at the moment, then this jobs report is the sort of final part of the puzzle, as it were, which we think will mean that they won't announce tapering this at the next meeting.
When will the Fed begin to taper?
Well, we think that I mean, they have signaled that they do, they think that they'll be ready to taper later this year. So we think that they'll probably make an announcement in November, at the November FOMC, to start tapering in December. Of course, that does depend on there being no further COVID waves. I think we're probably just about past the peak of the latest wave. But going into the winter months, it's possible that there could be another surge. The vaccination rates are improving, but are still perhaps not quite where they need to be to fully protect the country against further COVID waves. You know, if activity remains weak, then the Fed may decide to delay tapering until next year. But at the moment, it's seems most likely that they will make an announcement, not at this coming meeting, but at the one after in November, and start tapering in December, if not early next year.
How will the taper affect the US market?
Well, I mean, the taper will be very, very, very well flagged. It's not something that's coming out of the blue. It's not something which will come as a shock. This has been, you know, very widely discussed for quite some time now. So we think that there is unlikely to be, well, we're not expecting a shock. What does it mean for Treasury yields? Treasury yields are very low at the moment. To the extent that the tapering program really is the very early part of Fed tightening policy, the next step would be a rise in interest rates. You know, we would expect that Treasury yields will probably start to rise, but very gradually. So we're not expecting a repeat of the taper tantrum that we saw back in 2013, where, you know, a suggestion of tapering by Ben Bernanke at that point triggered a big sell-off in the Treasury market. The one thing to watch, obviously, and the one thing that policymakers and markets will be watching very closely is what happens to inflation. We have seen some signs that inflation is easing back, at least on a month-by-month basis, even if the annual inflation rates are still high. But if we start to see high wage demands becoming embedded in the labour market, and that in turn underpins higher inflation, then you know, if the Fed looks as if it's being too slow to tighten policy, then we could see a more dramatic market sell-off, which would mean a jump in yields. But that's not our central scenario. We think that there will be a sort of gradual rise in yields. For the dollar has been relatively strong, but we think that the environment in which the Fed is able to taper very gradually is one in which the global economy is doing well, and we would actually expect the dollar not to strengthen further, but if anything, in a sort of more risk-off environment for investors to be looking for gains in other currencies.
If the Fed begins to taper, what should other major central banks do?
Well, other major central banks are all operating similarly, I would say. So every major central bank is looking at what's happening to the real economy and what's happening to inflation. And we've seen some moves already from central banks in Latin America, where concerns about higher inflation have driven policymakers to raise rates already, starting earlier this year in Brazil, for example. In Central and Eastern Europe, we've also seen the sort of Russian central bank raising rates because of concern about inflation. Now, in these cases, you had highly negative real interest rates, so central banks are trying to move rates back up to sort of to zero at least. For other central banks, still a reasonably sort of cautious approach. The Australian Central Bank is probably going to start tapering. The Bank of England, we think, will start raising rates before the Fed. There are additional inflation concerns for the Bank of England, but we don't expect anything to happen this year, more likely sort of later next year. For the European Central Bank, we have the meeting this week, and we think that they are not likely to raise rates anytime soon. They have a new policy framework where they have a 2% inflation target, and they would tolerate inflation being above 2% for a period of time. So they may slow their purchases, and they may make an announcement about that at the September meeting, but we don't think they're going to be raising rates anytime soon. So really, all central banks are operating according to their own circumstances. In many cases, a similar set of considerations to the Fed: what's happening to inflation, what's happening to employment, what's happening to the real economy, how far do we have to be prepared for further COVID shocks?
From the recent economic data like manufacturing PMI and the service PMI, what can we learn?
Well, I think we can learn that activity is holding up reasonably well, although at a slightly slower pace than we saw earlier in the summer, and that can largely be assigned to the COVID impact. We can also learn that there is, pretty strong demand for labour, but there are supply side constraints, both in terms of the labour market, but also in terms of broader supply chain issues. That's been a constant theme of, both on the manufacturing side and similarly on the services side. So I would say that the latest PMI data are pointing to a slightly softer pace of growth for the third quarter than we had in the second quarter. The second quarter, we saw a sort of resurgence in growth after the vaccinations started to have a positive impact on COVID cases.
Do you think the US inflation will fall in the fourth quarter?
I think the sort of monthly inflation rates already seem to have gone past their peak. And if we look at the breakdown of what's happening to inflation, then it's clear that prices of durable goods are starting to slow. So for many years, actually decades, durable goods inflation was negative in the US. And what changed from late last year was that the costs of durable goods started to rise, and that was again a pandemic impact. People were no longer spending on services, they were spending on goods, and that combined with supply chain disruptions drove prices higher. But that durable goods inflation does seem to be coming down now. Services inflation and inflation in non-durable goods, so food and energy, is still sort of running at a similar pace in July as it was in June. So not much change there. We would expect that from sort of the current high energy costs that we're seeing now will start to fade over the coming months, and that would suggest that we would see slower underlying inflation being reflected in inflation indicators in the US. So we're not expecting a further acceleration in inflation, but inflation is already pretty high. We would expect it to start to slow over the coming months.
Besides the pandemic, what key factors will create long-term inflation pressures?
I think it's too early to say for long-term inflation. We know that there are some factors that have caused inflation to stay very low in recent years, particularly relating to the global supply chain. And obviously, you know, many Western countries are still benefiting from low-cost imports from Asia in particular. But the supply chain disruptions are, you know, causing some issues there. And it may well be that as we see moves to onshore, that there is a sort of reset of or rethink on reliance on global supply chains. So it's possible that some of the factors that have held inflation very low in recent years will no longer be so strong. Having said that, other factors are likely to continue to hold inflation low, in particular the advance of technology, and we've seen a big sort of move ahead in technological use through the pandemic. So that ought to be a factor that does hold inflation low. Demographic factors as well, we think are likely to hold inflation low. So over the medium term, there are factors that you know, are likely to be more inflation supportive, but overall we're not expecting to see inflation moving permanently or staying permanently above central bank targets.
Would you like to predict the future of US economy, especially in the fourth quarter?
Yes, I mean, for the fourth quarter, we should see activity picking up again after this temporary slowdown, which has been related to the rising in COVID cases. I think that we are past that peak now. We seem to be seeing hospitalizations leveling out, albeit at a relatively high level, but vaccinations are rising. And the pandemic impact should fade. There's certainly a lot of support coming through, not just from the Fed, so interest rates remain very low, but also from the government with the sort of infrastructure and climate and welfare related spending bills going through Congress at the moment and likely to deliver ongoing fiscal support to the economy. So, you know, there are a number of factors that will be very supportive to growth in the US, and you know, the pandemic impact we think will fade in the fourth quarter, so that should allow growth to pick up again.
How about global economy?
Yes, I mean, for the global economy, it's still COVID and the pandemic that is very dominant. If we look at the Americas, first of all, then I mentioned earlier that a lot of Latin American central banks are raising rates because of concerns over inflation, but they're also tightening policy because growth has held up better than expected, or growth has recovered better than expected. So, and they're benefiting from ongoing high commodity prices, demand for copper and other metals obviously is supportive there. If we look at Europe, then the economic picture seems to be pretty good. Certainly in the euro area, the economy is on track to meet the ECB's targets, GDP targets. For the UK, strong spending is driving growth forward here. So across Europe, I would say that growth is you know, is looking pretty good. And then for Asian economies, we know that in China, the recent surveys fell back due to the pandemic, but again, there it seems as if the latest wave has passed. We would expect that impact to be temporary, and again, sort of very good policy support, which should be underpinning growth in spending, in consumption, and a pickup in investment, set against a very an ongoing accommodative policy backdrop. For other economies in the region that have suffered from very high pandemic case loads, again, with the exception of some countries where numbers are still very high and where there are still quite tight restrictions, we're seeing a sort of turnaround in general, economies recovering. Still relatively early days, but policy remains supportive, and the global economy opportunities for exporting are still are looking better. So for the global economy, we think that with the exception of some countries, the outlook is reasonably positive.
It seems that we need to watch more inflation data and jobs reports to assess the U.S. economy in the future. All right, thanks, Sarah.
Thank you. Bye bye.
以上就是本期全球财经连线的全部内容，感谢收看。